3 EV stocks, Rivian, NIO, Tesla. Where should you buy them? Guys, EV was the thing just a year and a half. Over the last 5 years, Paul, you don't get it. EV is the future. I get it. EV is the future. Just like the internet was the future in 2000, and you still saw 95% plus internet companies going under. Just this week alone, Rivian announced that they're recalling, drumroll please, 100% of the cars that they've manufactured.
Unfortunately, this truck is now a complete and total brick. The key fob won't work. I'm currently locked out. None of the keys work at all, and Rivian themselves, they can't even access the vehicle. Now, Rivian says that they're going to send a tow truck and they're going to look into the issue. This will be the second time that this truck has already been to service. Not a good look for Rivian.
They said they're being safe about it, but my point about this is this. Not that Rivian's a crappy company, not at all. My point is that anything can happen. And when everybody overpays for such small and young companies, guys, the growing pains of companies are so difficult, anything can happen. So when people pay top dollar because they say, hey, this is the future. Of course it's the future. You know what else is the future? Cannabis. We're going to have a lot more marijuana sales in the next 50 years than we have today. That doesn't mean that every marijuana business is going to do well.
Absolutely. And the competitive advantage of the EV world, I mean, we both drive EVs. Charging is getting more expensive. I just drove to Asheville, North Carolina this weekend. I spent $210 in gasoline. I took an internal combustion engine. If I would have taken my Tesla, it was $125.
Oh.
So, I mean, yes, it's less. Absolutely. But this number was probably $50 6-7 months ago.
And go look at the cost of electricity over the last 15 years and where it's gone. As this world becomes more and more driven by electric vehicles and other uses of electric, the cost is going to go higher. I'm willing to bet, I'm going to make an unpopular statement here, that even though I've said in the past, I think the world's going to be all EV in the next 15, 20 years, I'm starting to backtrack a little bit on that because all that's going to happen is electric business is going to say, hey, listen, it's a drain on our resources. We have to do more. We're going to charge more. Look at California. California talks about EV as the future and everything, but now they're like, oh yeah, you can't charge your vehicle between these times. It's like, wait, what is going on here?
You told us to go this direction.
So let's go check it out right now. Let's go to our software. First stock, Rivian. By the way, I like Rivian's truck. I think it's beautiful.
They're great. I mean, even if you watch a lot of reviews on YouTube, it's a very nice car. There's no doubt.
The stock hit an all-time high of $126 in the last year, and their low was $19, and they're currently at $31. So let's go check out their 8 pillars. Not enough data. Why? They haven't been around for 5 years. Guys, our 8 pillars are very, very useful for companies that have been around more than 5 years. And the reason being, I like to focus on those companies. That does not mean that you have to ignore all these companies because they haven't been around 5 years. Just realize that the more track record the company has, the easier it is to understand how they go through cycles. We have not seen a full cycle for companies like Rivian. We have not seen a full economic cycle. We haven't seen a full bull and bear cycle. It has been hard. Yeah. So let's go use our software and look at the analyst estimates. Earnings per share. These analysts have the company losing $6 a share for the next 5 years, essentially. Let's go to revenue. Guys, keep in mind, the company in the last 12 months did $500 million in revenue. Analyst estimates. They have them doing $81 billion in revenue by 2026. And that's 12 analysts with the average expectation of $81 billion. Now, this is where I sit there and say, guys, what has to happen for this company to do $81 billion in revenue? That's a tough ask. Not making money, boy, oh boy. I'm actually surprised by that. I want to see who the analysts are. Now, here's the problem. Our stock analyzer tool is useful if you have some sort of profit. Even the analyst expectations are for no profit. Mo?
So I have Tesla's revenue up here. They did $67 billion last year in revenue. They've been around. I mean, let's go back here. We're going back to 2009 when they did $62 million. So they're saying that they're going to grow way more than Tesla did. That's their assumption if they're going to go to $81 billion in revenue.
Yes, correct. But they're starting at a higher level.
They are.
Rivian did $500 million last year.
Correct.
This
but
is
still.
Let's go to stock. Let's assume this company's making money. Guys, here's the hard part. This company, oh boy. Okay, let's just go and do revenue growth. 40, 30, 45, and 60% revenue growth. Let's do profit margin of a car company, 3, 5, and 7. Now, guys, remember, this assumes they start making money tomorrow.
Yep.
Okay. 3, 5, 7. PE, 16, 20, Nope, because when it's big, it's not going to be worth that. 15, 17, 19, 15, 17, 19. And guys, this is a lot of assumption. I want a big return.
Guys, this is all speculation what he's putting in here.
This is $1 on the low side, $10 on the high side, 4 in the middle. That's assuming it makes profit and cash flow tomorrow. Makes profit and cash flow tomorrow. And I'm putting a high desired return. I should have a high desired return. Why? There's a lot of speculation here. The company has so many guys. You've seen Tesla, how many issues they had in their growth. And recently, when the stock was skyrocketing, Elon Musk came out and said, we were 2 weeks away from bankruptcy several times in the last 5 years.
I think in 2018 or 19, that's the last time he said it.
I don't remember the exact date. You might be right, but it was recently. You sit there and go, damn. So anyways, that's Rivian. Mo, go NIO.
Okay, NIO. So this is big over in China. Lots of EVs over in China. And I will say this, from everything that I've seen and everything I've watched online, they do make a good car. But again, look where we're at here. No 5-year PE, no 5-year price to free cash flow. Guys, it's so difficult to look at these companies. I mean, it's a $22 billion company right now. It's not knocking the company and the car and the products, but the stock, you have to know what to pay for it. They had a 52-week high of $44. Today, they're sitting at $13.50. Let's look at these analyst estimates.
They have them profitable in the next 5 years.
They do have them profitable. They do.
Look at the revenue.
Oh, my God. Nearly $350 billion in revenue by 2026.
And the idea there being that they're in China.
Yeah.
They'll be hopefully the number one automaker in China. And China is a very fast-growing middle class, so they'll dominate that market.
Right. I have to think that there's going to be more competition in China as far as these EV go over the next couple of years, but let's see. All right. You know what? Because we're speculating here, I'm going to put in there 54% on the high side for revenue. Let's go with 35 and 45, and we'll just go 55 for the heck of it. Profit margin.
I think 35 on the low side is still high.
Well, of course it's high.
Okay. Profit margin. Do 3, 5, and 7.
Okay.
Because it's still a car company.
Yeah, exactly.
3, 5, and 7.
You know what's funny? I was reading an article the other day on the morning show that Elon Musk was saying we're using these humanoids and stuff, and we want to become more than a car company. So everybody that's saying it's a tech company, the CEO of the company is saying we want to be more than a car company. All right. Free cash flow. I'm going to do the same number, 3, 5, and 7. PE. What did you do? 17?
I did 16. I don't remember. I think 14.
Let's go.
No, I did 14, 16, 18.
Okay. We'll go 14, 16, 18 just to keep it consistent with the other company. Price to free cash flow, I'm going to do the same thing. Those numbers should level out over a long period of time. And return, I'll go 15, 20, and 25%. Current price, again, $13.50. What do we need to pay today? Okay, so if you believe these high assumptions of 45% and 55% revenue growth over the next decade with these types of returns and these types of profit margins, well, there you go. You can start looking at this. But for me, no, not yet. I want to see more. I want to see more coming from this company or I look somewhere in this $10 range. Maybe I throw it on my watch list around $15 and start looking at it down there. But even then, 35% revenue growth.
Yeah, the 45% takes them to $200 billion in revenue in the next 10 years.
Yeah.
All right, last one, Tesla, the more established one. 8 pillars. Oh, boy. 400 PE ratio, 440 price of free cash flow. Yes, they're growing a lot, but still keep that in mind. They've diluted people 25%. They have revenue growth, net income growth, and free cash flow growth. We love seeing that, but a very low return on invested capital, which I'm okay with because this is based on their cash flow, and their cash flow is probably negative for the first couple of years.
Can we just point out 52-week high of 414.50, current price of 222?
Yeah, and it's going to the moon.
Yep.
Analyst estimates. Big profit growth numbers, supposed to triple from this year. Okay, revenue growth, they're going to do, so two of the car companies we looked at, the previous two, analysts think they're going to be bigger than Tesla in the next 4 or 5 years. So that's something to also remember. Tesla will be considered the slow guy and the loser at some point in the future. Let's go to our stock analyzer tool. What was what growth rate over the next?
They have in there.
20 to 30. Okay.
Yeah.
I'm going to go with growth rate of 10, 20, and 30% over the next 10 years. So at 30% revenue growth.
Yeah, what's this?
For
revenue?
10 years. What's their current revenue?
67.
So it takes them to almost $1 trillion in revenue.
Yep.
In 10 years.
Okay.
So actually, I'm going to go a little bit lower. I'm going to go 10, 17.5, and 25. Profit margin. Guys, I don't think that 1 year profit margin is sustainable. Let's say they even do better and they're 5, 8, and 11%. Because remember, they're still a car company. Still a car company.
CEO said it. He literally said it last week.
Pre-cash flow, I'm going to do the exact same thing. PE, 15, 20, 25, 15, 20, 25. Guys, these are ridiculous.
They are.
12, 14, and 16% returns. I'm just showing you how overpriced the company is. Even with those really, really, really high assumptions, high price of 145, low price of 21, mid price of 60. Guys, I personally believe it's a $30 or $40 company based on today's numbers and with the growth rates going. Let's change this to 15, 20, and 25%. And let's change the profit margin to 6, 8, and 10, 6, 8, and 11, 6, 8, 11. We're still struggling here. This just tells me it's overpriced. Yep. And you might sit there and say, no, the potential's huge. That's what this does. It factors in potential. That's what the first line of this is revenue growth, big potential. So guys, if this video makes sense to you, I encourage you to watch 4 or 5 other videos. If you do that, you will walk away with a better understanding of money and investing. And even if you don't agree with Mo and I and everything, which you shouldn't agree with us, you'll still walk away saying, wait, these guys have a pretty good process, but process isn't just it. You need the emotional fortitude and the mindset to be successful investing. So watch our next video where we talk about emotions, mindset, and process to be a successful investor. Thank you very much for your time. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?